An $84 million BlackRock Bitcoin dump headline hit the internet and triggered instant panic. People saw one red number, assumed the biggest name in finance was abandoning Bitcoin, and hit the sell button like the building was on fire. But that story is backwards. What actually happened was a normal ETF mechanic that got packaged as a crisis. And if you react to it the way the headlines want you to react, you donate your money to calmer players who understand the plumbing. I'm your host, and this is a straight-to-the-data breakdown with zero hype and zero fear. Here's the promise. By the end of this, you will understand what that $84 million outflow really means, why it happened, what it does and doesn't signal, and how to turn this kind of headline from a threat into an edge. Stay with me, because the gotcha detail most people missed changes the entire meaning of that number. Let's start with the cold facts, not the emotional interpretation. A single trading session showed a net outflow of roughly $84.2 million from the BlackRock's spot Bitcoin ETF, commonly tracked under the ticker IBIT. On that same day, Fidelity's spot Bitcoin ETF also saw outflows, around $49 million. Add up the major U.S. spot Bitcoin ETFs, and the combined net outflow for the day was roughly $133 million. That's the number the internet screamed about. $133 million out. $84 million from BlackRock. And if you only consume markets through headlines, your brain fills in the rest. Institutional exit. Smart money leaving. This is the top. Bitcoin is done. Sell before it goes lower. But you need to pause right here, because this is where most investors get manipulated by misunderstanding structure. An ETF is not a company deciding to buy or sell Bitcoin like a trader. An ETF is a container, a wrapper, a vehicle built so other people can get exposure. BlackRock didn't wake up and pull money from Bitcoin. They created an investment product. Investors put money into that product. And those investors can also pull money out of that product whenever they want, for 1,000 reasons that have nothing to do with Bitcoin's long-term thesis. So when you read, IBIT had an $84 million outflow, the literal translation is simple. Some investors sold their ETF shares that day. That's it. No boardroom meeting, no corporate BlackRock is dumping, no secret memo, no institutional apocalypse, just investors exiting positions through a product that makes exiting positions extremely easy. This is the part the headlines blur on purpose, because fear gets clicks. Now let's go one layer deeper. How does an ETF outflow even happen? A spot Bitcoin ETF issues shares that represent exposure to Bitcoin held in custody. The ETF owns Bitcoin on behalf of shareholders. When demand is rising, new shares are created through the creation mechanism, and the ETF's Bitcoin holdings can increase. When investors redeem and exit, shares can be removed, and the ETF's holdings can decrease to match. That process is called redemption. It's normal. It's not scandal. It's not a hack. It's not a crisis. It's a mechanical adjustment. And here's the most important reality check you can apply to this entire story. Scale. IBIT is not a tiny fund. It holds tens of billions of dollars in assets. Depending on the day and price, you're talking somewhere in the neighborhood of $40 billion to $50 billion plus. Now do the math in your head. $84 million sounds huge when you say it fast. But as a percentage of a $40 to $50 billion product, it's tiny. It's a fraction of a percent. It's not a vote of no confidence. It's not a stampede. It's not institutional abandonment. If you had $50,000 in an account and you withdrew $100, would the world call it a collapse? No. You'd call it a normal Tuesday. This is why context is everything. Numbers without context are weapons, and the media loves weapons. Now here's another detail that makes the panic narrative fall apart. Trading volume. On the same day the outflow happened, IBIT was heavily traded, meaning the product was active, liquid, functioning exactly as designed. Some participants were selling, yes, but others were buying. The market was two-sided. An outflow day doesn't mean nobody wants this ETF. It means net selling outweighed net buying through the flow mechanism. That can happen even while massive volume changes hands. So here's the first cliffhanger. If the outflow number is not inherently bearish, then why did it happen that day? What triggered the selling? Because the why tells you more than the what. Zoom out. Bitcoin doesn't float in a vacuum anymore. The ETF era has tied Bitcoin tighter to macro behavior. Rates, liquidity, risk appetite, equity weakness, policy uncertainty. When the system tightens, Bitcoin feels it, not because the thesis dies, because positioning changes. At the time of these outflows, Bitcoin had already cooled off from a blow-off peak. Late 2025 saw extreme upside levels that shocked even optimistic holders. After that kind of run, pullbacks are not surprising. They're structural. Markets breathe. They expand and contract. The problem is, retail investors only notice the contraction and call it the end. Now layer in the Federal Reserve effect. When investors believe rates may stay higher, liquidity may tighten, and risk assets may struggle, what do? They reduce exposure. They rebalance. They move toward cash and bonds. They hedge. That is not a statement about Bitcoin's long-term destiny. It's a statement about risk management under uncertainty. And here's the ETF era's most underrated feature. ETFs made Bitcoin exposure liquid in a way it has never been for institutions. Before spot ETFs, if a large institution wanted to cut Bitcoin exposure, it wasn't always simple. Custody, on-chain transfers, exchange execution, compliance layers. It could be slow, operationally annoying, sometimes politically difficult inside the institution. Now, they can reduce exposure in seconds, sell shares, done. So yes, flow swings can be sharper, faster, more reactive to macro headlines, and that's exactly what you're seeing. Mean Bitcoin is weaker. It means Bitcoin is more integrated. And integration cuts both ways, because the same ease that allows quick selling also allows quick buying. When the macro tone flips, flows can reverse fast. When risk appetite returns, exposure can flood back in through the exact same pipeline. So the real question becomes, who was selling? Was it BlackRock? Or was it a specific class of ETF holders managing short-term risk? Think about the kinds of participants who use ETFs aggressively. Short-term traders, macro funds, hedge funds, institutions running tactical allocations, people who will sell a risk asset before a Fed headline and buy it back after the headline clears. They don't marry positions, they date them. And that's why a one-day outflow number is not a moral judgment on Bitcoin. It's a snapshot of positioning. Now here's where the story gets genuinely interesting. While short-term participants can create noisy outflow days, long-term institutional players behave differently. Sovereign wealth funds, government-linked pools of capital, pensions, large family offices. These players don't flip positions because of one red day. They operate on years and decades. They think in cycles, not candles. And in recent filings, you've already seen evidence of long-horizon capital getting exposure through Bitcoin ETFs. These are not crypto bros. These are conservative allocators whose job is to preserve and grow national or multi-generational wealth. When that class allocates, they don't exit because Twitter gets scared. They rebalance, not retreat. That's the key psychological divide in markets. Retail reacts to pain by running away. Professionals react to pain by checking their plan. And the plan is usually allocation targets. If Bitcoin drops and their BTC exposure shrinks as a percentage of the portfolio, a disciplined allocator may actually buy to restore the target. That's what rebalancing is. So here's the uncomfortable truth. Headlines like $84 million outflow often cause the wrong people to sell at the wrong time to the right people. Fear is not just an emotion. Fear is a transfer mechanism. It moves assets from impatient hands to patient hands. And it's been doing that in Bitcoin for more than a decade. Now let's shift to the part that actually matters for you. Not the theory, the action plan. Because if you watch the market like a spectator, you get played. If you watch it like an operator, you get options. Step 1 is learning how to read ETF flow data like a professional. Daily flows are noisy. A single outflow day tells you almost nothing about the health of the product or the asset. What matters is the trend. Weekly, monthly, quarterly, cumulative. If you see persistent net outflows for weeks across multiple ETFs, that's a signal worth investigating. It could suggest shifting sentiment. It could suggest systemic repositioning. But one day? One day is weather. Most people confuse weather for climate, and they make long-term decisions based on short-term noise. So here's your rule. Stop reacting to single-day outflow headlines. Start tracking multi-week flow behavior. Track cumulative net inflows since launch. Watch how flows respond to macro events. Over time, you'll start seeing a pattern most retail investors never see because they're trapped inside the headline loop. Step 2 is separating price from value. Price is what you see. It moves constantly. It's driven by emotion, leverage, headlines, liquidation cascades, and narratives. Price is loud. Value is the thesis. For Bitcoin, the thesis includes a fixed supply cap, a decentralized monetary network, resilience across cycles, and increasing acceptance as a macro asset and diversification tool. It includes the reality that large pools of capital can now access Bitcoin exposure through regulated vehicles. Now ask the key question. Did any of that change because of one day of ETF outflows? No, not even slightly. So if price moves but thesis does not, you are not seeing the end. You are seeing volatility. You are seeing a discount or a shakeout depending on your time frame. The best investors in any asset class are not the ones with the highest IQ. They're the ones who stay calm when the crowd gets emotional. That's why this IBIT story matters. It's a perfect example of how the market weaponizes misunderstanding. Step 3 is building an information diet that protects your decision-making. Crypto media is optimized for engagement, not accuracy. Social algorithms amplify fear because fear keeps you scrolling. The more terrified you are, the more you click. The more you click, the more terrified content you get served. It's a loop designed to keep you reactive. If your market view comes mostly from viral posts, thumbnails, and breaking headlines, you are looking at reality through a funhouse mirror. Upgrade your inputs. Follow primary disclosures. Track official flow summaries. Use data platforms. Watch analysts who explain their reasoning, acknowledge uncertainty, and don't swing from moon to zero every week. Because your information diet isn't entertainment, it's portfolio management. Now, step 4 is respecting the cycle. Bitcoin has a long history of repeating emotional phases: fear, doubt, capitulation, stabilization, recovery, optimism, euphoria, then fear again. The names change, the headlines change, the prices change, but the psychology stays. The outflow headline is a fear headline. It's part of the cycle's uncertainty zone. And historically, the uncertainty zone is where informed investors build positions carefully, not where they make panic exits. Does that mean price can't go lower? Of course it can. Uncertainty is uncertainty. But the investor who waits for comfort usually buys late. Comfort arrives after the move. Now let me ask you directly, because this is where your self-awareness becomes your edge. When you saw a BlackRock $84 million outflow, what did you feel first? Fear? Relief? Curiosity? Did you immediately assume smart money is exiting? Or did you ask, who is actually selling and why? And second question, do you track weekly ETF flows and cumulative flows, or do you only see the daily panic headline? Answer honestly in the comments because your answer tells you what to fix. Now here's the final twist, and it's the one most people miss. The ETF era didn't make Bitcoin weaker. It made Bitcoin more accessible. And when an asset becomes more accessible, the short-term noise increases because more participants can push buttons faster. But the long-term adoption pipeline also becomes stronger because capital that could never touch on-chain Bitcoin now has a regulated door. So one outflow day is not the end. It's the market breathing. It's positioning shifting. It's traders managing risk in a system that now has a fast on-ramp and a fast off-ramp. That's all. If this breakdown gave you clarity, do two things. First, subscribe, because I post data-first, calm analysis designed to make you harder to manipulate. Second, share this with one person who is panicking about ETF headlines, because the fastest way to lose money is to let fear interpret numbers for you. Stay sharp, stay disciplined, and remember, the story you're sold is rarely the story that happened.